Welcome to my channel, I'm James, and today I'm going through my valuation methods of Activision Blizzard. What we're going to be doing is looking at their financial statements, then using two different models to give my price targets based on discounted free cash flow model and the Buffett-Graham intrinsic value. Is this stock a buy or a sell? As you can see, Activision Blizzard has had a massive price increase over the last few days from $65 a share to $82 a share. The reason for this is that Microsoft decided to buy video game maker Activision Blizzard for $75 billion, making it one of the largest tech acquisitions ever. So a little bit about Activision Blizzard. They develop and distribute content and services on video game consoles, personal computers, and mobile devices, including subscription, full game, and in-game sales. The company's key products are Call of Duty, World of Warcraft, Diablo, Candy Crush, Hearthstone, and Overwatch. If we look at the share price over the last year, you can see it has gone down. It was around about $92 a share, hit its all-time high at 107, and then has been on a massive sell-off since then. It was definitely undervalued at this point, and the stock has rose up and is now at about $82 a share. Activision Blizzard currently has a market cap of $64 billion. It's in the communication services sector, and the share price is $82.31. It pays a 0.57% dividend, and the ex-dividend is the 14th of April, so buy your shares before then if you want them. Firstly, we want to see if the PE ratio is less than the market, and Activision Blizzard currently has a PE ratio of 24.37, and with the market at 26.59, it is lower than that, so that's a pass. Now we want to look at increasing revenue, and this is the amount of money the company brings in from goods or services it sells. We want this to increase as it shows growth, and as you can see here, the revenue has increased $7.5 billion to $9 billion. Now we want to look at the profit. This is the net income, and this is the total revenue minus expenses. We want this to be increasing and positive, and yes it is. It's gone from 1.8 billion to 2.6. Next, we want to see if the shares outstanding are decreasing. Companies can buy back their shares, which make it more valuable to shareholders. For example, if the company has 1 million shares and 2 million in income, it has an earnings of $2 per share. If they buy back 500,000 shares, it will now be $4 a share, more valuable for shareholders. As you can see, the shares have gone from 754 million to 771 million. This is bad because it means that each share represents a smaller percentage of ownership, making the shares less value, and therefore the earnings per share will go down. But if Activision and Microsoft invest this capital that they can get from selling the shares, and then they invest it in the company, and then this in turn drives the company's share price up, this is not a bad thing. And finally is the free cash flow increasing. This is the cash the company generates after all the expenses and everything's paid. It's the cash from operations minus capital expenditures, and it's gone from 1.6 billion to 2.8. So overall, that is 4 passes and 1 failure, and it has a free cash flow ratio of the market cap divided by the free cash flow, which is 22.8, which is about the same as the PE ratio, a little bit slightly less valued. And with this dividend of 0.75%, that is a current dividend of 365 million, and it is a very safe dividend because the free cash flow is 2.8. Now we're going to look at discounted free cash flow analysis. I've estimated the future free cash flows based off analyst estimates on revenue and discounted them to today's value. And based on these estimates, you can see that Activision has a calculated stock price of $102 a share and 57 cents, which means it's even now it's still trading at a 24.6% discount. Then the next valuation method is the Buffett-Graham intrinsic value. This uses earnings per share and expected growth rate, and Activision expected to grow 13.26% over the next few years. And this gives a fair value of $118.37, which is a 43% discount. So both of these models are saying it is a buy. So Microsoft definitely did the right thing in buying, and hopefully you will too if you purchase the stock. Right guys, thanks for watching. Please give a like on the video, and I'll catch you guys next time.